the deal could be between 6 and 8% a month is what they get paid. And then at the end of the deal, when we sell it, they get, we want to be providing about a 20% annualized return on.
That's amazing.
And that's what we've done. We have the track record. We've done it.
This is the Money Seed Podcast, where we discuss all things investing, plain and simple, the way it should be. Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice.
Welcome back to the Money Seed Podcast. My guest today is Stephanie Walter. Stephanie is the CEO of ERBE Wealth. Stephanie, welcome to the show.
Oh, thank you so much for having me.
So Stephanie, tell us a little bit more about ERBE Wealth. What is ERBE Wealth?
It's a company that I started several years ago when I decided that I wanted to do syndicated real estate, which is basically just a fancy word for a bunch of people buying a piece of commercial real estate. It's that's usually bigger than anyone could do on their own. So I began to capital raise and work with a lot of really wealthy investors. I love it. We've closed, like I said, about 12 syndicated deals at this point. And just working with the wealthy investor gave me opened my eyes to how they're investing and how they look at their money, their mindset about money, and how they use their money. So for me, that opened up a lot of my eyes of how to invest. I switched some of my own stuff around after watching them and was able to retire and sell. I had an insurance agency for 16 years. So I was able to sell that. And really my passion now is just like educating people and letting them know about these different strategies that we're not taught, and
Absolutely.
We don't know anything about them.
So Stephanie, how do the wealthy look at money differently, right? I mean, most of us are told, hey, have a 9-to-5 job, save some money, put it in 401ks or some mutual funds. You'll be fine. You got nothing to worry about. And yet the wealthy don't typically do this. They have completely different ways. Talk to us a little bit more about how do the wealthy do it differently?
Well, first of all, they have a different mindset about money. And it took me a little while to figure out what their mindset was. I think we're taught as a generation, at least our generation anyway, is to accumulate money and, just keep squirreling it away, throwing it in a 401k. We're not overly concerned of what it's invested in, just that it's invested. Many times, most of us have no idea what kind of fees we're being charged or really anything specifically. That's very different than how the wealthy look at their money. First of all, they view it in terms of utilization. So it's a small thing, but it is a mind shift that needs to be made, and that your money is working for you. Your money is your employee. What are you doing for me? So in that sense, they're actively investing in things that produce them cash value, and good returns at all times. And many times that means they're investing, in real estate, in companies, the direct companies. So, where I say, someone who invests in a 401k, you invest in mutual funds, which are literally hundreds of companies. And you personally, as the investor, know nothing about any one of those companies. I bet you ask them any one of the companies, they don't know who's running the company, what their experience is, what their plan is for the future of the company, and what their exit strategy, if there is one. Now that's completely unacceptable to a wealthy investor who invests directly into a company or possibly even several companies and does know all of those answers. They vet who's running the company, their experience, how they performed in the past, and things like that. So they tend to invest in real tangible assets that produce cash value for them.
And Stephanie, one of the things that caught my eye when we talked about this earlier was that a lot of the wealthy individuals have figured out a way to have reliable income in retirement tax-free by leveraging real assets. Tell us a little bit more at a high level. How is that even possible?
Well, this has been relatively new information for me. And please understand, I was in insurance for, 16 years. I was an actual insurance agent selling the product. But before that, I was 8 years. I worked more on the corporate insurance side, and I'd never heard of this. These are extremely specialized insurance products that are sold by people that know what they're doing. And what they are is it's called premium finance insurance. And so what that is it behaves very much like a real estate product. So you you put 20% down on a life policy. The bank contributes, the rest of it. And that money just continues to grow because this is a particular product that takes the up in the stock market, but takes zero in the down. So you don't lose any money ever. And that's another that's an important part to know about wealthy people is they don't tolerate losses. They just don't. And so what this product does over time, like we're talking 10, 15 years, is it continues to grow. Think of it like it's $1 million, let's say, and the stock market for that particular year goes up 7%. Now, you're not making 7% on just the $200,000 you put into the policy. You're making that 7% on the $1 million that the bank contributed. So that's what makes this strategy very powerful. So by the time 10 or 15 years goes by, the client is able to take out tax-free income because it's housed in this life insurance structure. The benefit of that is that it grows tax-free and can provide tax-free income when they retire. And that is incredibly a powerful thing to have tax-free income in retirement.
And Stephanie, what is that setup called? The one that you just described? Is there a name for it? I mean, I've heard names like infinite banking or spendthrift trust, or what is there a name for it?
It's none of those. A lot of people get the infinite banking. They think that this is what that is. Infinite banking is done with a whole life policy, and it is not really, there's a lot of problems with that particular structure that we see. So we use what's called an indexed universal life policy. And so that's why I say it's tied to the market in the up, but they get zeros for, like, say it went down 25% last year, you get a zero. And that's very powerful when you're trying to grow your wealth, to not try to dig out of a hole when you lose money. But yes, and it's called, the actual concept is called premium financed insurance. And it's essentially having a bank contribute to your life insurance policy. And at some point, I guess the next question would be, are you paying the bank? Or what are you doing? Actually, the way that we set these up, the bank gets paid after about year 10 and pulls their money out. Yet the kind of the engine of this policy is already well on its way at that point, so it doesn't affect it. And the insurance company loves these types of, the bank loves these types of loans because they're secured by the life insurance. And then I guess the cherry on top is at the end of the day, when you're taking this tax-free income and you pass away, say you live to 90 or whatever, this is still a life insurance policy. So after you've taken all the income out of it, it's still, when you pass away, you can still leave a good sum of money to your beneficiaries. So it's very good. It's very specialized at. It's been around for a very long time, but it's been utilized by the extremely wealthy. We're talking net worths of 25 million. And recently it's become more utilized by people that have a net worth of $1 million.
Got it. And that was going to be my follow-up question, was roughly what is the minimum threshold of a net worth or annual income that you would recommend this kind of product to people for?
Kind of like an accredited investor. So if you're familiar, to have $200,000 income or joint income with your spouse, 300,000, or have a net worth of $1 million. So yeah, that's where that lands for people.
And I'm always amazed at the different types of life insurance products and ideas out there. I mean, I always thought, growing up, I'm in my mid 40s now, and I always thought life insurance is pretty simple. You buy a life insurance policy. If something happens to you, then, if your family is taken care of. And yet life insurance world has so many different things you can do with policies that really, it was only until like maybe a year ago when I first heard the term infinite banking for the first time. And I'm like, what? You can do other stuff with life insurance and not just kind of sit there and park it. And it's opened up this whole world for me where I'm just amazed at the different types of financial products and instruments and solutions that are available in the life insurance space. It's mind-blowing.
Yeah. I am as well. And I was pretty shocked because I have an uncle who's 80, and he's recently retired from insurance, and he was only a life and just a life agent his whole life. And so I ran this by him, and he had never heard of it. So to say it's special, it's extremely specialized. So if you go and you look it up, even on the internet, there's not a whole lot of information about it, but it's a valid strategy. It's I know people always think, oh, insurance companies, they're bad, or Susie Orman or Dave Ramsey, but these are strategies that the very wealthy consistently use, and I am always interested in what they're doing.
That's right. Yeah. And I was really puzzled. I know there was a video that went viral about Dave Ramsey a couple of years ago when somebody called in and asked him about infinite banking, and he really just basically trashed the idea. Like, Dave Ramsey is not a big fan of it, even though there seem to be some very viable infinite banking strategies out there. Dave Ramsey's opinion on them was quite negative, which surprised me. But maybe it's because he doesn't want his audience to focus on that. He wants his audience to focus on like different types of financial habits and other types of investments. And I guess everyone is entitled to their own opinion in that regard. Exactly.
And I think actually, I was just talking to a certified financial planner and explaining this, and he was like, they believe real strongly in one way of doing things, and it's very hard to open their mind to something else. And I think there's a reason that most Americans, really most of them, have the 401k and don't really think of anything outside of that. And it's just, I don't blame any person in particular, but I know that a lot of financial companies and money managers and stuff like that really benefit from your money just sitting in a place, being invested for 30 years before you take it out and use it. And even then, I think people are a bit in denial about how much they're going to be able to take out of that pot, because that's sort of where the financial planner kind of disappears, is like when you're ready to retire, they're like, hey, all right, start taking the money out. And I think they did some kind of a poll of people that said most people think they can take 10% of their nest egg out. And what I heard is most recently from Morningstar came out and said you can take 2.8% out. And that is taxable income too, on top of it.
When
so
you say
if you have $1 million, you take out $28,000.
Yeah, and what you mean is $28,000 every year, right? Like to last you through retirement, that would be your annual income you can draw from, which is very little if you think about it, right? And that's what I'm saying. I think the 401ks in general are going to leave a lot of Americans disappointed. It's not going to give them the lifestyle they think they're going to have in retirement, because it's very misleading, right? Yeah. Like you said, wow, I got $1 million in my 401k, and that in reality that they're only looking at $30,000 a year they're pulling from that, and it's taxable to some degree. Yeah. Social Security is not going to be that much, like $1,500 a month, maybe $2,000 by the time I mean, you add it all together, and it's like $40,000, $50,000 a year, and they're paying some tax on that, it's not gonna be the lifestyle they think it is.
Yeah. And that's a part of my passion, is just to, educate people. And it really is never too late. I mean, the average person that we usually set up these policies for are in their 50s. And the mindset change is, you have to start thinking maybe not so much about accumulating, but think about the income, because that's all that matters at the end of the day when you retire, is what is my income going to be? And start putting things into place that give you the income that you want in retirement.
And a little bit about the financial planners you mentioned earlier. There's two things I learned about financial planners, right? And one is, they are, generally speaking, when you go see a financial planner, they have two really strong motivations to give you a certain kind of advice. One is a very real concern. One is that they don't want to get sued, right? If they recommend, hey, Stephanie, just put your money in a Vanguard mutual fund, you'll be fine. They know they can say that and they'll never get sued, because it's out there. It's a professionally managed fund. It's been in existence for 30 years. They have a proven track record. It's not bad advice, right? It's not the best advice they can give you, but it's not something that's going to land them in trouble. And the second thing is, they know what kind of commissions they get for selling you that product.
Yeah.
And so really, if you put those two together, it's very unlikely that a financial planner is going to say, hey, listen, don't do that. Do this other life insurance policy instead. Or, hey, go invest in real estate. Or, you know what? Maybe if you are a credit investor, you want to try investing in a startup or some other syndication deal. They're not really incentivized to do that.
No, it takes the money out of their pocket. And yeah. And I just was talking to someone the other day, and he's like, yeah, talking to my guy, and he's having me, move my money into other things. And I was like, where is he putting the money? And one of the places were REITs, which are real estate investment trusts. But that is honestly probably the worst way that you could invest in real estate. I think, because you get no tax benefits. And this is linked to the stock market. So it's I feel like, because it's so easily liquidable, that you minus out a lot of the benefits you get if you go and invest in a syndication directly. But that's just, those are my thoughts.
Yeah, and I was just going to shift the gears to syndications. But getting back to tax-free income, one of the things that I discovered with real estate, because I got into real estate a few years back, right, is that if you buy a property and the property appreciates, and let's say 5-6 years later, you refinance it, at that point, that is not a taxable event. You haven't sold it. You're just pulling money out of it. And so the money you get is really tax-free at that point. Yes, you are kind of deferring the capital gains to some future date, but there's all kinds of tricks you can do to kick that can down the road with 1031 exchanges. And there's even a way to move back into the property in your later years, or to give it to your kids, etc. And so there's a good chance that you will never, ever pay the capital gains on those. And you can just kind of pull the money out of that, pull the equity out, tax-free, enjoy it. So you buy a property in your 40s and you have $100,000, $200,000 of appreciation. All of a sudden you're in your 60s, you can pull out 50,000 of it tax-free, 100,000 of it tax-free. It's another great vehicle to have access to your money, let it grow, but then not have to worry about the tax side of it when you pull it out. But
yeah, absolutely. And that's a big thing, I guess, of the myths of that I wrote about in my book, is that wealthy people are very conscious of taxes. They're very aware of what their tax liability is. They're always planning to mitigate, and do what you're saying, refinance, or, do a 1031, or even taking advantage of syndications. They do a lot of, there's lots of tax benefits, because even though you own just shares of the real estate, you actually own the real estate. So you get all those benefits, which is depreciation and cost segregation, things like that. That really lower your rates because at the end of the day, I think that, I know that taxes next to inflation are the two largest eroders of wealth that we have. And I was reading something the other day about inflation, and say, I don't know, they say it's like 4 or 5% right now, which, that's debatable. But just looking over 20 years, what that does to like $10,000, people are not prepared. I know they aren't of the inflation and the reduction of their buying power as a result of that.
So Stephanie, tell us a little bit more about your recent syndications and what kind of clients you're looking for, what kind of projects and properties you're looking for in your deals.
Well, we've been doing a lot in Florida because that's where one of my partners is located. We've been doing multifamily in Florida. And so that's been a good, very good. We're also in the process of looking at retail centers because actually we did a retail that we're going to be cycling out of this year. And it is done the best out of any of our properties. So we're constantly looking at different markets and different opportunities. But usually, when we present whatever deal we have, we want to be sure that, number one, our investors are getting a preferred return every month. That's about, depending on the deal, could be between 6 and 8% a month is what they get paid. And then at the end of the deal, when we sell it, they get, we want to be providing about a 20% annualized return on.
That's amazing.
And that's what we've done. We have the track record, we've done it. So that's why it takes us, we have maybe 1 or 2 deals that we do a year because it takes a lot of looking to find a deal that will do that. And
that's amazing.
Yeah.
Yeah. And I always tell people it's amazing. I've spoken to a lot of individuals such as yourself who are into syndications. And I always tell people, like people who are investing in real estate and are doing syndications, they're usually getting like between 15 and 20%. Like that's not uncommon.
Yeah.
And that's almost like double, right? That's pretty much double the stock market, right?
I mean, our goal, like our mission statement, is to double our clients' money within our hold period. Now, I think the hold periods are probably going to increase just because of the economy. But up until this point, it's meant about 3 to 5 year hold periods. But I mean, we've done better than the 20%. And in fact, like I'm talking about this retail center, we did 40. We're going to be selling it in the next year. In the next few months, actually, and it's going to return 40% a year to our investors. So
that's insane.
Yeah. So it's incredibly, satisfying to get those returns to our clients. But it's really not that uncommon outside of like what you're saying. If you find a good deal, have a good plan and implement it correctly, then, people are like, well, the retail, what about COVID? Wasn't that a nightmare for you guys? And it actually wasn't, it was in Florida, but, that's why I believe that you need to buy in areas that, we really, really do major market research. But in that particular area, the businesses were down for a really short time. And I think there was like a short period of time, where they didn't pay the rent for a really short time, but it didn't affect anything going forward for us. So
yeah, I feel like a lot of people who were in Florida during COVID probably had it easier than in some other states. So I think you guys definitely were in a good place there. But yeah, so getting back to the returns thing, I mean, you're in the stock market in a 401k, 8%, maybe 10% a year. All of a sudden you move to commercial real estate and multifamilies and the syndication space. And now, like you said, you're getting 15, 20%, maybe more. It's an amazing difference to your portfolio, to someone's retirement planning, because it's a lot. When you add in compounding, it's not twice, it's a lot more. For example, what I'm saying is,
right,
if somebody's investing at, say, 8% every single year in the stock market, they're getting returns of 8%. And the same person on the other side, they're investing the same amount of money, but in a syndication deal that's getting them like 15, 20% a year, you seem, oh, it's just, twice the interest rate, it's going to be, twice much money at the end. No, when you look at compounding interest, results are going to be much, much bigger, right? For the person doing
Yeah.
the 15-20%, it's a much, much different picture when you look at it 10, 20 years down the line. I'm talking like many, many times more, not twice
Oh, yeah.
more. Yeah.
And also you can't really compare because you're getting the tax benefits
That's
too.
right.
So my tax bill every year, I make, a pretty good amount of money, and I rarely pay taxes.
Mhm.
I have a tax refund coming to me almost all the time because of the depreciation of buying these huge assets, because they are huge. Our last one was over 500 units in Orlando. So,
Mhm.
there's a lot of tax benefits that people overlook. In fact, it's usually that time of year when taxes come out, the K1s, our investors get the K1s, and then they're like, oh, okay, nice, but it takes them seeing that for them to realize what a benefit it is.
Absolutely. And it really only was maybe until like 5 years ago that I stumbled on this idea that successful real estate investors generally don't pay a whole lot of taxes. And it's because the American tax code just really favors people who develop and improve real estate, right? I mean, we all need housing, and the tax code incentivizes people to invest in real estate. So if you want another reason to invest in real estate, it's because of low taxes. Absolutely.
Yeah.
And Stephanie, I was really surprised when you mentioned, so you pay your investors monthly. I mean, I've heard of other syndicators who pay them quarterly or semi-annually or annually, but you pay out monthly.
Yes. Yep. That's the way that we decided we wanted to do it, because people, I don't know, they just like receiving a check every month. And again, that just is another reason, people don't think about, when you're retired or whatever, other streams of income. Like, I'm a huge advocate of that. It doesn't have to necessarily be real estate. There's other insurance products that provide you with consistent monthly income. But what I see with the wealthy is they're very diversified, truly diversified, not like diversified in the stock market. They've got some money that is getting paid to them from annuities, some that's getting paid from real estate syndications, some that's, being paid through, business acquisitions or investing in private equity. So yeah, but I think the view is different. As opposed to building up accumulation, they're very concerned with building up income, because at the end of the day, I used to have a lot of single family rentals in Denver, and the goal was I'll just hold them until they're all paid off, and then I'll get the rent. But I was only getting maybe $100 of cash flow out of them. It was a pain in the butt. And then I realized I could roll these into the syndications, and I sure love receiving those checks every month. That income is really nice.
Absolutely. Stephanie, tell us about the book. I believe it's called Shattering Money Myths: How the Wealthy Invest.
Yeah. Well, that's my new book and my first book. And I believe I wanted to write it because when I've been going on a lot of podcasts, I tend to get asked the same type of questions. And it made me be like, well, these are really good points of how the wealthy invest and how the wealthy look at money. And also looking at, I think there's a chapter, not sure which one it is, if it's 4 or 5, but that one is really important for people to look at, which is the when the stocks go down, when your 401k goes down, how long does it take you to recover from these losses? And simply, the wealthy really look to mitigate their risk and not have any losses. They look at Warren Buffett's famous quote, rule number 1, don't lose any money. Rule number 2, never forget rule number 1. And that it's significant, because I know my mom back in the day, she had that loss in 08, 07, 08. And that was about I don't know what that entailed for her, but I know just recently she's come back up to where she should be with the money that she had in the stock market. So, I mean, it takes a really long time when you have a loss. So if you can just really stop the losses, and invest in things that are not really volatile, like tangible things like real estate, you're not going to have those types of losses, and you can get where you're going a lot quicker without, sustaining those losses.
Diversification is a lot more than just picking different types of stocks. I agree with you 100%.
Yeah.
Stephanie, thank you very much for your time today. Where can people learn more about you and ERBE Wealth?
You could go to my website, which is www.erbewealth.com. And I have my book there to either download or I can mail you a copy. Certainly, I'll offer the people in your audience to be able to do that for free. So I definitely take advantage of it. I've told people that have read it, you know more than probably 95% of the people, period, after reading this book. And it's pretty short, but it's definitely eye-opening, I think. Because even if you choose to stay, invested in the 401k, it gives you strategies to be invested in a product that has the least fees, because those fees are killing people. That they pay out. So yeah, it's a good read.
Thank you very much for that, Stephanie. I'll drop that in the show notes as well as the other links that we discussed. Stephanie Walter, ERBE Wealth, thank you very much.
Thank you. Thanks so much for having me.
Hey, thanks for joining us for another episode of the Money Seed Podcast. Please remember to click like and subscribe. It really helps spread the message to other investors, and it helps attract new viewers to the show. We appreciate your support. Thanks very much.